go. Welcome, everyone. We are going to hear about undergraduates at Lehigh University who have been working on an interesting project called Falling Knives. They will tell you everything about it. So you could see, you'll get to know them. And hold on. Wait.
Oh.
Hold on. Not ready yet. You'll get to know them. But let me introduce a few other students. In the meantime, I've got Ramos Wu, who is going to be joining the Masters in Financial Engineering in 2021. We've got Mike Mogarakai and Randy Parker, who are going to be joining in the fall of 2020, and they will be taking this course as a capstone for the Master in Financial Engineering. What I mean, this is one of the projects that we'll be offering. We have several other projects, but I think this is an interesting project because it could have lots of ramification in terms of your own view on portfolios and stock performance. So, without further ado, guys, take it over.
Great, thank you, Professor Zora. Okay, so hello everyone. This is the Falling Knife Project. My name is Trevor.
I'm Dalton.
I'm Shikidu.
I'm Andrew Park.
I'm Eric.
So we're gonna start off by talking about what we've worked on this summer. So the agenda for this presentation will include a project background, an in-depth analysis into the database that we decided to create for this project, and then we're going to get into the program development. So we have the indicators, the process for finding falling knives and displaying falling knives, and then we have two different fundamental analyses on specific falling knives within certain industries. So to start off, what is a falling knife? So from Investopedia, a falling knife is a term for a rapid drop in the price or value of a security. So there's a saying in finance to not catch a falling knife, as in you want to wait until the price has bottomed out, and at that point an investor would want to buy it then, and they would want to know at what point the price would be lowest before they buy it, and then the price goes back up so as to make a profit. So the goal of our project was to make it easier for an investor to understand what a falling knife is and to be able to find a falling knife better. So long term, this project is looking to create a machine learning algorithm that would be able to predict and detect falling knives before they would happen. And this would allow an investor to be a smarter investor. So we decided for our project that we needed to create a database of many different data points that would allow us to build off of this and help in later creating our algorithm. So from our capstone CSV team, we were given a variety of different CSV files that contained data points on S&P 500 companies. So all of this data was spread out. It was not cohesive. So we decided that we were going to clean this data throughout the summer, and we were going to narrow down the focus of our years to be a smaller time frame. So our time frame is about like 10, 15 years, spanning from like around 2005 to like 2019. So we merged all this data together to create one large file, one large database that would allow us to run different Python algorithms on it and allow us to play around with the data so that we could better understand it and use this to better detect falling knives going forward. So we have two different approaches. There's a fundamental approach, which is measuring the security's intrinsic value based on just the brand or economic and financial factors. So this isn't necessarily dealing with numbers. This isn't something that we can necessarily have within our database. But then the other approach is quantitative, which is using mathematical and statistical methods within finance. So this includes PE ratio, RSI, MACD, and a few others. So within our database, and our focus for this summer was working with the quantitative approach, since we were able to use our data in combination with Python and various financial Python libraries to try and create some visualizations of what a falling knife looks like.
So talking about the quantitative approach. So one of our goals for the summer was to create a tool that the Masters of Financial Engineering team will be able to use to detect these falling knives based on different criteria. So using the database we established, we combined, we used a technical analysis Python library, which used the open, close, and volume data points within the database to implement various quantitative indicators to filter our data. So when used, we can filter our data by the stock ticker within the SP 500, the time frame that the user sets, and the various technical parameters that we want to use. So looking specifically at the indicators, we chose to implement MACD, RSI, the stochastic oscillator, and the accumulation distribution index. Overall, there were about 34 indicators that we could choose from, and they were grouped based on momentum indicators, trend indicators, volatility indicators, and volume indicators. Overall, we felt that specifically the stochastic oscillator would be useful because it allows you to recognize when a stock has moved into an overbought or an oversold position. And after researching more about the indicator, I learned that it has a high degree of accuracy, which led me to believe it'd be a good tool for our program. So essentially, we just wanted to make this tool very simple to use. How it would work is the user would indicate which stock ticket they want to use, they indicate the time frame they want to use, they choose which variables they want to actually filter the data out by, and then they can graph that specific indicator and the other indicators they want to show at the same time. So for example, with the graph currently on the right, we chose to use Apple's stock data. We chose to filter by their RSI. So when it reached a point of below 35, it would indicate in our program that that is a falling knife. And as you can see by the red dots, those are all the instances of a falling knife. And then we chose to also graph the MACD at the same time, so you can see how it looks on that graph and on the closing price. So hopefully, at the end of the day, using these indicators in the project, the MFE team will be able to more easily identify these falling knives, and they can choose which indicators in the database will actually be useful and have the most impact on the algorithm. Hopefully, they can also use this for like research purposes, and they can continually improve upon the program and add other indicators that they think will be useful.
My goal is to build a quantitative approach, which I call loss-based predictive method, to find falling knives and their beginning and ending, which are probably the selling and buying point of a falling knife. Then I will test my approach by comparing its total return with the return of just holding those stocks. Next. So for the algorithm behind my method, I first create two groups of moving average. One group is short-term one, from 3 days to 15 days, and the other is long-term, from 30 days to 60 days. Then I will compare the minimum of the short-term moving average and the maximum among the long-term moving average. While the minimum of the short-term groups is smaller than the maximum of the long-term groups. It's the start of a falling knife, which is also a possible selling point. Otherwise, it indicates the end of a falling knife, which is a buying point. Then I will test it on all companies in Nasdaq 100. Next slide. You can see on the graph the upwards triangle is start of is the end of a falling knife, and the downward triangle is a start of falling knife. So for the result I found from my method, first, my method is unable to profit with those falling knife which never comes by. Like the company has a really bad news during those period, and stocks fall down and never come back. So, but it still has smaller capital losses than just holding the stock. And also, another interesting point of my method is my method works better for ETFs such as TQQ and SPY rather than just individual company stock.
So, like Trevor mentioned, we took both a quantitative and a fundamental approach to this falling knife problem. And so what I worked on was a fundamental approach to oil stocks and the falling knives within there. I chose the oil industry because the sector has a lot of volatility in it, which means there's often going to be falling knives within the industry, and also because it's largely speculative. So one important thing about the oil industry is that different companies do different activities within it. You have upstream companies in it that do the actual drilling and exploration, midstream companies that do the moving and storage, and then downstream activities that do the refining and the actual sale of the final product, right? And so something about this is that they're often highly correlated in their stock price movement, and it would appear that a shock to one part of the supply chain would have lasting effects in other parts of it. And in addition, I also selected the oil industry because the release of new information has very predictable effects on what's going to happen with the stock price. So the process that I used is I selected 16 different companies that capture the upstream, midstream, and downstream activities within the oil industry. And then I combined their stock prices over time into a data set. And then I coupled that data with a bunch of other factors that have some impact on the price of these stocks, such as planned oil production, the amount of oil currently in storage, those sort of things that drive these different stock prices. And then what I did is I made an interface that allows the user to decide what stocks they want to plot and what data they want to compare those stock prices against. So on the right, you can see the simple interface I made. You can select, what companies you want to see. In this example, I decided to plot it against the spot price of oil. And then you can also see that you can adjust it by the date so that you can really narrow in on these falling knives. And so the next steps for me with this is going to be continuing collecting more relevant data that has an impact on these falling knives. And then also, once some patterns are found, I'd like to apply some different statistical methods to assess the accuracy of the patterns that are found.
So like Delton, I also took a fundamental approach. I wanted to segue into the healthcare sector as opposed to the oil. So what I wanted to do here is I actually pulled out a specific metric or two, as well as analyze macro factors such as competition, patents, and external circumstances that might impact companies in the sector. While trading stocks, healthcare sectors have three types of companies. So there's healthcare providers, healthcare payers such as insurance companies, and producers. And producers do make up a majority of those companies, ranging from pharmaceutical industries, medical devices, and equipment. So the industries range in competitiveness. So I wanted to find a correlation between those the company performances between each other and see if any falling knife data points correlated. So next slide, please. So my goal was I wanted to compile a database. I wanted to find falling knife data points over a 13-year period, utilizing the companies on the right for providers, payers, and producers. I first did this utilizing with like a Yahoo Finance backtesting method that Ramos did, but eventually that developed into me utilizing the database pulling together the healthcare CSV files and finding those individual data points. And I also wanted to put it together with the data of the quarterly diluted earnings per share of each company with producers. Producers with being the largest, I wanted to see any correlations there and see if there was any link to that we could use for falling knives. And then I wanted to just basically look at these data points, compare the companies, see if there was any patents or external circumstances that may have led to this, if there's any correlation between a producer's falling knife and what it did with the providers and the payers. So by doing this, next slide, Trevor. So of the analyzed data points as producers, so 45% found themselves sharing a falling knife with the lowest diluted earnings period. Because the falling knives do range in time period based on the metrics we set. There was obviously some quarter overlap, so there were more times for the falling knife to reach, but it didn't appear to have a strong correlation. When I also looked at the average price change exhibited between the three types of companies. Producers exhibited the most drastic price change on falling knives, about 23.9%, and a lot of those price drops are seen due to late stage drug and product failures, discouraging data. Because these producer industries are so competitive, such as the pharmaceutical industry and the medical device industry, which saw the largest price drops at 26.5% for pharmaceuticals. Companies, the trend with these falling knives is that the data was so discouraging and the industry so competitive that when you saw that drop off, people are more willing to get out. They want to diversify their portfolio, which is a note. And then looking at the falling knives that correlated between the providers and the producers, about 65% of the producers also saw a falling knife data point in the worst data point that was provided for the providers. So I looked for the most drastic price change that a provider exhibited in that time period. I wanted to see what the producers were doing, and it showed that the producers were also having a falling knife at that time. In addition, what I also found in the industry is a lot of the payers also in that time period have falling knives. So there is a byproduct that could be just general economy trends, maybe overlap with the companies. But it was interesting to note that that during these radical price changes in the providers, all the health company payers exhibited a price change that was below their company average. So I had the averages compiled for their average price change, and seeing that the payers always were at least 6 or 7% below was just something to note. How when the most radical changes happened in providers, payers had something that was below their average. And I think